Commodities, and let's start by taking a look to see where we closed for the week. Looking at corn on this shortened week, we closed up 11 and a half cents in the main contract, right at 371. Soybeans closed up 13 and a half cents in the main contract at 955 and a half. Wheat up just shy of 6 cents in the May at 429 and 3/4 over in the livestock markets. Cattle, the big winner this week, up $5.32 in the April contract at 125.37. Hogs down 87 cents in the April contract this week at 62.45. And taking a look at the energy market, crude looks as if it's going to close around 75 cents up on the week in the main contract, right around $53. So somewhat steady sideways trading range in crude from last week. And it looks like the dollar is going to close about 70 points lower on the week, somewhere around that $1.40 area, 140 last. Trump talking the dollar down a little bit here this week, looking for a weaker dollar to help out maybe some of the trade, and also it did weigh on the bond market as well. Taking a look at the grains, the big news item this week was the monthly supply and demand report. We were wondering how the USDA was going to incorporate the larger than expected stocks from the quarterly stocks report and the acreage report at the end of March into the monthly S&D balance sheets. And with corn, they didn't do anything. They let that carry out right at $2.32 billion. That's what we were last month. They did increase ethanol demand 50 million bushels, but they went in and reduced feed demand 50 million bushels. All said and done, left it alone. The interesting thing is they did increase world stocks more than expected, upping both in South America, upping both Brazil and Argentina's corn crop. Taking a look at the bean balance sheet, the trade was looking for a bump in soybean stocks as well, due to the larger than expected stocks that we found in the quarterly stocks report. And we did see a 10 million bushel bump up from last month at 445 million bushels. Interesting enough, that came from the residual. We did see a little bit increase in seed demand, but we've seen the residual drop off enough to offset that. Residual basically tells us that the trade, or NASS at this point, believes that last year's soybean crop may have been bigger than estimated. So putting those numbers behind us, we've seen a sell-off in the soybean market. We put in yearly lows in the May contract below 930. It ticked below 930 upon the release of the report, only to have a strong close and finish Tuesday and some follow-through strength in the last couple days. So the soybean market has rallied off of negative news at this point. And the other thing with beans is China's demand continues to be voracious. We've seen the largest exports and or imports on their part for the month of March ever on record, so a very strong month for them. So that's helping the demand side of the equation to keep this large world supply of beans coming. The other thing moving forward is acres. Taking a look at the weather market right now, we know that there's a little bit of concern about corn planting. That's not necessarily bearish beans, but history shows that there is concerns with late planting. It does help the soybean market as well as the corn market. But flipping on over, taking a look at the corn market, we are seeing a little bit of strength here as well. Following the report, concerns are now with all these reports behind us. It's Mother Nature. It's a 2-week forecast. Are we going to get it planted in a timely fashion? Some are touting that at this point. Really, we don't need to be concerned about that until May 1st. Historically, we have around 37% of the corn crop planted as of May 1st. So we're a long ways away from it at this point. And the other thing to take a look at is we're nearing the top end of some recent trading range. Again, when you take a look at the Dees corn contract in particular, we have only been above or closed above Dees corn 2 times since last summer, 2 times above $4 since last summer. And we are approaching those levels. We're trading right around that 395, 396 area right now. So it may be an opportunity to get some hedges on here in the short term. We still have the growing season ahead of us yet, but there isn't a concern about short stocks this year at this point. We still have a large carry out for both corn and beans. And even if we do get a little bit of rally in the futures market, unfortunately, it could weigh upon the cash market and form a basis. Look for a quick rally in the futures probably to see that basis widen out, work against us in the cash market. Maybe both so corn and soybeans at this point. Moving on over to the livestock market, cattle futures have been on a pretty strong rally this week. As I mentioned earlier, we've seen that May contract up there close to 125.50. Cash trade did develop today, stronger than last week, stronger than expected. Some 128 is traded in the south. We're seeing some 208 trade here in the Corn Belt. So stronger than expected cash trade. So you take a look at that April contract. That basis has come in quite a ways. With 2 weeks left until option expiration, we are firming that basis. The cash and the futures are doing what they're supposed to do, but you're looking at a huge discount to June contract at this point. And the question moving forward is June futures undervalued, or are cash going to be coming down to meet that futures contract? There is some concern about pulling forward cattle, that maybe we are seeing some lighter weights out there. Maybe we're pulling more ahead than we need to at this point. So hard to hedge cattle up in the deferred contracts right now at such a discount to the cash market. There may be some less risky ways to do that through the options. Take a look at the hog market. Unfortunately, as strong as cattle has been, hogs have been the opposite at this point, down 87 cents in the April, with Monday being the last trading day in the April contract, and we do close against the cash index, which through last Tuesday was 64.12. So we're still trading a little over, or just under $2 over the April contract at this point. Those will offset each other. And then you take a look at the June contract, or we do have the May contract a little bit more lightly traded, but there is a carry in the market there as well. Cash has continued to fall out of bed. Futures are on the downside or on the bottom side of the recent trading range. The cutout seems to be holding in here quite firm. I would look for rallies still to be selling that June contract. I don't want to be a hedger at this point in June or any of the deferreds. I'd want to be a hedger on rallies. Other than that, is things that we need probably to take a look at here in the upcoming weeks is basically Mother Nature. Take a look at that 6 to 10, that 8 to 12 day forecast. We are showing above normal rain. We are seeing some below normal temps coming in that 8 to 12 day forecast. That will probably dictate the price or the rally, and if there is a rally in the corn or soybean markets in weeks to come. And again, we do have a fund right now that is short corn, short wheat. Most likely, when the report is released tomorrow, no trade tomorrow, but when the report is released on Friday, we will probably see maybe a small short in beans as well. As we sit here today, that may not be the case. That is a lagging report, but you have a fund right now that is short this market, when historically you see them a little bit long going into the uncertainty of the growing season. That could provide some more short covering rallies for us in the weeks to come. Take advantage of those rallies if they do come, because as I mentioned again, it's been a tough go to see Dees corn over $4 as far as new crop. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2424.